Last week saw July end and in doing so post the best returns for US equities since 2020, with the S&P 500 up almost 10%. And it wasn't just equities that had a move. Commodities rallied, the dollar and bond yields fell. It seems riskier assets are back in vogue. But why did this happen, you might ask? Well, in large part, it's due to what the market is calling the Fed pivot. With many investors expecting a recession in the next 12 months, for those that don't believe we are in one already, that will bring prices down and give the Fed enough wiggle room to start cutting rates once again. We recently saw a shift from bad news is bad, because the Fed has to hike anyway, to bad news is good, because now there's a chance the Fed will start cutting once the macro starts weakening. So if we are now in a topsy-turvy world again, is in fact the rally of last month bad news for markets? And that's this week's big conversation. First, let's take a step back and set the scene going into last week. We got the 75 basis point hike that seemed all but assured, but with some new language that suggested the Fed show more flexibility at coming meetings amid signs of a slowdown. Now, although Powell didn't rule out another similar-sized increase going forward, he stepped away from the specific guidance that he gave at the June meeting. And whilst Fed officials denied that the US was entering a recession, pointing to resilience in the labor market, the consensus focused on the potential for a moderation in the pace of future rate hikes, given renewed data dependence, with some investors even going as far as to call this the pivot. Now, as debate ensued between Fed watchers, equity investors cheered the news with a decisive rally, which saw the more speculative corners of the market, notably the high beta, long duration constituents of the NASDAQ and the ARK ETF, posting outsized gains. Furthermore, they removed guidance altogether and said the pace of increases will depend on the data, which means key figures like the ISM, which came out on Monday, are going to be a factor. And we'll come to that in detail later on. As we said in the intro, yields also moved, but it wasn't just the broad decline in yields that supported the market's dovish interpretation of Powell's comments. If we look at the shape of the yield curve, we have now seen long-end yields fall faster than short-dated yields, which seems to support the interpretation that growth expectations are falling rapidly enough to force a pivot from the Fed. Now let's talk about that rally, because you might find it counterintuitive to pose the question, are rallies bad for markets? After all, aren't we all here to make money? But remember, they are also a reference for monetary policy makers. Yes, the US monetary policy is fixated on prices and employment, but they do also watch the market. And higher asset prices themselves might well be considered inflationary, posing something of a circular reference problem for the Fed. Now this week, we got a perfect example of exactly that market awareness when Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis, suggested on Friday that investors had gotten ahead of themselves in anticipating that the Fed would soon begin to back off. His exact words were, "I'm surprised by the market's reaction." Now, the inference of that is the Fed did not get the reaction they expected, but they still might not be too disappointed by the rally. I mean, for much of the last decade, the Fed was arguably acting with a dual mandate of targeting growth, but also supporting asset prices. Whenever the economy wavered or the stock market wobbled, investors were conditioned to expect the Fed put. But with the Fed now explicitly targeting price or inflation above all else, the current dynamic is markedly different. Rather than the market buying the dip on the Fed's support, we may be witnessing a role reversal where the central bank sees a tactical opportunity to hike on market rallies. And that's not to say that hikes are by any means contingent on equity market strength, but the rebound in July might well have provided more wiggle room for the Fed to continue pursuing its inflation target with further increases in the face of an economic slowdown. So yes, rallies are good, especially for fund manager performance, but perhaps not so much in the specific environment that we're in right now. Until inflation is under control, they may well be enabling the Fed to press ahead with larger rate hikes in the near term and risk contributing to a recent inflation problem if asset prices rebound before the Fed has achieved its price mandate. Now let's talk ISM for a second. July's ISM manufacturing PMI came out on Monday and provided some valuable insights into the state of the US economy. Now, first of all, the headline index continued to signal expansion with a reading above 50. That also beat expectations and was only down 0.2 points on last month's reading of 53. Now, the bulls will rest easy, claiming it suggests the economy is not in dire straits right now. Plus, if you dig a little deeper into that number, the price index, which tends to provide a lead on changes in CPI, posted a surprise drop of 18.5 percentage points, which was by far the biggest change in any component of the report. Although it may be premature to call for this as a peak in inflation on this basis alone, when taken in consideration of the softening in oil prices recently, alongside the fastest hiking cycle in decades, this might carry more weight in foreshadowing a fall in CPI. And if the stronger than expected headline reading of 52.8 is a sign of things to come, then perhaps the Fed was right to deny the presence of a US recession. But then again, that too might be seen as a step too far, as elsewhere in the report, we saw new orders continue to drop while inventories rose. Now, bears will be quick to point out the fact that every single time the spread between these two has fallen to this level, a recession has ensued. Now, again, as much as the Fed has tried to downplay recessionary fears, there are still many investors who believe that we are already in one, or maybe on the cusp of one that just isn't too deep. But my point is that we know that data matters a lot now, so keep an eye on it as it comes out. And just sticking on the ISM for a second, because let's just be clear, this is not just an equity story. In fact, it never is. As we've said many times before, all asset classes are interlinked, so it's important to keep an eye on all assets to get a better understanding of what's really going on. And it's along those lines that we have a very interesting point to raise. Asset prices can imply a level of economic health of the market that they operate in. What I mean by that is US equities and US bonds have adjusted to levels that imply ISM readings, and by extrapolation, scenarios for the US economy. But what's startling here is that the two tell very different stories. The US 10-year is generally agreeing with the latest data, suggesting that things are basically okay. In fact, bonds are pricing an ISM above 50 in expansionary territory, which provides a growth runway for the Fed to continue hiking. Now, equities, on the other hand, are pricing in the ISM below 50 and much lower if you look at the growth tech names. So why the dislocation? Well, it's important to note that the level of yields is likely to be supported somewhat by the hiking cycle that we are in the midst of. But the truth is that the two asset classes often tell different stories, and bonds are the less effervescent cousins of equities. But one of them must be wrong. Now, another explanation of the dislocation is that equities do have a more emotional component in their pricing. And right now, investors in economies are on an edge, walking a fine line through the Scylla and Charybdis of inflation and low growth. So, before we look ahead to how this scenario might play out, let's quickly cover two other notable market inputs: earnings and sentiment. Now, with the majority of the S&P 500 having now reported, I think it's fair to say that things haven't been as bad as investors were fearing. The percentage of companies beating on EPS is down slightly, but still close to the long-term average of around 70%. But if you think about where sentiment was going into earnings season, it wasn't going to take big beats to see stocks rally. Whilst there have been certain outliers, it seems that earnings beats have seen less of a reaction than misses, which have tended to be punished harder. Now, given that Q2 hasn't been as bad as many as expected, this has led some analysts to expect that the weakness could now come later in the next quarter. And that brings me on to my last point: sentiment. This market remains volatile and is adapting to a barrage of important information. But if you can think back to June, it was a month of despair, with investors bracing for hard landings. Fast forward to now, and we have a double-digit rebound in the S&P 500. A better than expected earnings season, clues that the outlook for growth and inflation might not be as bad as feared, and a Fed that will pivot if needed. But equity and bond positioning remains somewhat at odds. So, where do we go from here? Well, this is where we return to the story of whether good data is now bad for markets. Well, if this rally continues, then the answer is yes, and increasingly so as risk assets appreciate. Remember, just like Neil Kashkari said, never for a moment forget that bringing down inflation is the Fed's priority right now, and they'll do whatever needs to be done to achieve that. Other regional Fed speakers have said the same. The conclusion here is that the July rally has arguably put the Fed in a better position than before to forge ahead with hikes despite growth fears that preceded the latest ISM report. And given the Fed is now explicitly putting data front and center, it's going to be all eyes on the various economic indicators we get in August to show us where we go from here.